Good morning, everyone. This is Paul Nalabondian coming to you for my monthly market session covering May 2025 and all the April data. Also joined, as always, by my wonderful colleague, Temi the Great. We are going to wait just a minute or so for people to get on. In the meantime, going to head back to my recent tradition, which is to share the cup of coffee I'm drinking this morning. This is an El Salvadoran coffee from Carlos Pola, roasted by Cat and Cloud. They are an incredible roaster in California. It is delicious. And between the cup of coffee and you all, this will keep me energized on this Thursday morning. So just really quickly, if we have anybody new, I'm Paul Nalabondian. I am a realtor with Fulcrum Residential and Keller Williams Capital Properties. I'm also a member of the Agent Leadership Council for Keller Williams Capital Properties, going on my 6th year here. Elite level realtor licensed in Virginia, DC, and Maryland here each month, bringing you the most important information related to the economy, mortgage rates, and the real estate market to keep you all up to speed and allow you to give expert advice to your clients as well. My colleague Temi, also with Fulcrum Residential. Do you want to introduce yourself, Temi?
Hey, yes, I'm Temi the Great. I'm here to support Paul, and I'm excited to listen in and to share market data.
And Temi will be helping to moderate, control the flow. I love it when this is as interactive as possible. So please, we don't have, now that we're switching to live stream, we don't have live conversation between the group and the two of us, but we are always asking for comments and input in the chat and would like this to be as interactive as possible. I can pull all the data in the world, but the granular boots on the ground, what we're seeing on a daily basis, that kind of input is invaluable, and that's what we all provide as a collective. So we're going to hit similar format that we follow each month. We are going to start off with the mortgage rates. Where are mortgage rates at for the
Oh,
various products?
really,
Yes.
really, really quickly, Paul. Hey guys,
Mhm.
just to show that you are on and engaged, if you could just share really quickly where you're streaming in from. Are you DC, Maryland, Virginia? Are you someplace else? We just kind of want to see where the audience is at and make sure the comment section is on and working.
Yeah, good point.
All right.
That would be wonderful to see. Also, with the live stream, we can't always see who is here like we could with Zoom. So if you want to throw your name on there, your brokerage, that would be wonderful. Also, just increase that sense of community and see who we're hanging out with on this wonderful Thursday morning. All right, so back into the format. We're going to start off with mortgage rates, like I said, the various products. Then we're going to look at segments of the economy that influence the mortgage rates so you can get an idea of where things might be headed. Then we are going to look at DMV specific real estate data. We're going to start with the most recently reported month, April 2025. Then we're going to take a look at the most recently reported week from May, see if anything is changing in these past couple of weeks. Spoiler alert, things are changing. It's really interesting. If you looked at just the market data from April, you would have a specific impression, and we're seeing things change a little bit in May, and it's really important to stay on top of this stuff because so much is going on, so much is changing with the economy right now. So very excited to talk about that. Then we're going to hit kind of how are new administration policies affecting things right now, and they're affecting all of our lives in a lot of ways, but we'll focus on kind of the core economic and real estate aspects of that. Then we're going to pop into key takeaways. So let's get rolling into mortgage rates. What are people seeing right now? Where are mortgage rates at? And I would love to hear this again, that kind of granular, boots on the ground, specific information that we can't necessarily pull from surveys. I would love to hear from anyone who's had a client lock in the past week, 10 days. What have they locked at? And if you could mention whether it's fee simple or condo. You can see here we have a lot of volatility, and that should be no surprise. That's what I've been talking about for a while. I said the only thing you can really expect for sure in mortgage rates in 2025 is volatility. And if you look at the chart, you can see right now, so we are right around 7% for 30-year fixed. And let me just see if mortgage news. This was from a day or two ago. Yep. Now we've crept up. Yeah, I knew we were creeping up. I wasn't sure exactly what they had reported. So right now, Mortgage News Daily, their most recently reported number is 7.08. And so that has gone up a little bit more already than where we were at just 1 or 2 days ago. And like I said, the only thing you can expect, the only thing you can know for certain when it comes to these mortgage rates is that there's going to be volatility. We're a little bit above where we were a month ago, but you can see in the chart here that we dropped down a fair amount, a little more than a quarter point. Now we are right back up again, and that's the expectation. We talk about takeaways for our clients. If people are waiting for mortgage rates to drop, that's not really the game to be in right now because no expert has a high degree of certainty of when that's going to happen. I'll talk about this a little bit more when we get into the further data, but there was a point where I would have bet a lot. In fact, I tried to bet one of our great local lenders, Todd Petey, I tried to make him a decent bet that we would see mortgage rates in the fives in the near term. I no longer expect that at all. I would make the reverse bet actually that we are not going to see anything approaching 5 in 2025. My expectation, a lot of experts expectations are just that we're going to see a lot of volatility and we're going to be kind of going in that band of 6.5 to low sevens for the rest of the year. So if you have buyers who are sitting waiting for these to drop, if they need to purchase anytime in the near term, all that's going to happen in all likelihood is they're going to be paying more for their home in appreciation in the actual sales price of their home, and then also with the mortgage rate, it could be even a little higher than it is now. Still would love to
I'm
see.
seeing, Paul, I'm seeing the last client that I had that locked in at 6.7, which I thought was high, but now makes sense. And that was I believe this well that was about between April and coming into May.
Mhm,
Um, that closed was 6.7. Before it was 6.3, like early April was 6.3. And now I'm seeing more 6.7s. Conventional, non-condo.
mhm. Yeah, and
Guys, what rates are you seeing?
that reflects
Put
what
it in
we
the
see
comment
here.
section. Yeah.
It's pretty sizable little drop, but now we are creeping back up. I mentioned last time, Tom saying 6875. Yeah, right in the range of what I'm seeing out there. Mentioned this last time, but something to keep an eye on is that I've for the first time since rates increased a while back, I'm seeing some good ARM products out there, and I've had some clients lock. Actually, had some clients lock in the high fives. That was before rates increased again, but have heard of other people's clients coming in right around 6 and in that range. So it
Mm.
a 5 to 7 year ARM product is probably a pretty decent bet because all expectations are that there will be a meaningful decline in mortgage rates in the next 5 to 7 years. So you would be refinancing anyway, and getting that, if you can get that good ARM product, that can allow you to save a lot of money in that interim.
Hey, Paul. So we have a question on Instagram, and I think you kind of touched in on that a little bit. It says, do you think it will ever get into the fours by 2028?
2028.
Oh,
That
he said, I mean fives,
Oh,
fives.
fives. Yeah, I see that's hey Ruben, how are you doing? Good to have you on here. Yeah, by 2028, fives, I would say for certain. At some point, it's just right now it's so hard to predict where things are going to be because we still don't know how all of these policies are going to shake out. And so this kind of segues into how are people feeling about the economy. And I'd love to hear in the comments how people are assumable loan. The yeah, pop over to that. Anybody who has VA clients in particular, if you can assume a VA mortgage, I have a client right now who is looking to do a VA loan, and we are focusing in solely on properties that have VA assumable loans because something like 275 we're probably not going to see again anytime, I would think, in the next decade. I mean, there would take like a major kind of world crisis like there was before in order for rates to get down that low again. So, and if you can get a VA assumable loan, that's an incredible deal because you're not likely to see those rates again. So going
Are
back
you,
to kind of
hey, Hey, Paul,
Yep.
sorry, quick question. Do you want him to get a VA loan because he's a veteran? Or is that the focus? Because there's also FHA that's assumable.
hmm Oh yeah, I'm sorry. Might not have been clear. The coffee might not have fully kicked in yet. He is in the military. He wanted to use a VA loan already, and because he has VA eligibility, we're keen in on existing VA assumable loans so that we can take advantage of that. Because basically, I mean, as most people probably know, anyone can assume a VA loan, but if somebody who doesn't have VA eligibility assumes that loan, that basically takes that person's eligibility for that dollar amount until the loan is paid off. So most people, when they advertise VA assumable loans, they would not actually let a buyer assume it unless they had their own VA eligibility. Yeah, and Taylor
Yeah.
commented on the FHA as Temi mentioned.
Yeah, and Christina brings up a good point. VA just recently, because I had a friend that was doing a VA an assumable mortgage, and it was taking forever. Because the bank who is doing the assumption has to agree to do the assumption. And so it was taking, for some banks, it was taking forever and things like that. But VA recently just passed something where you have to close a VA assumable mortgage in 45 days. That's not the same for FHA. I think one of the recent changes with FHA assumables was, I think the max fee was like, I think $800 that could be charged, and now they've changed it to, I believe, around 1,800. So they've increased the max fee that can be charged for to process an assumable mortgage, to be able to help servicers get more people in to process that out. So you'll start seeing some changes in the assumable mortgage round.
hmm hmm Yeah, that's interesting. Thank you for sharing, Temi. Um, d- don't want to continue moving on, chugging away, but I do want to. Tyranny mentions and a great point that assumables are nice, but there can be a barrier because you're only assuming the the balance left on the mortgage, and the gap between that and the sale price you will have to cover either in cash or a secondary mortgage. And it's possible to get a secondary mortgage to cover it, just complicates things a little bit. Okay, so question was, how are people feeling about the economy? Don't really have to wait for a response on there because most people are feeling bad. The University of Michigan, kind of the bellwether poll, considered gold standard for consumer sentiment. Last month, they came back. They had consumer sentiment from their poll at the second lowest level since they began tracking this 50 years ago. Well, the most recent month is even lower than that. So now the most recent month has surpassed it as the second lowest month of consumer sentiment since they have started tracking this 50 years ago. So people are worried about the economy, and people are worried about tariffs as well. In this poll, 75% of people mentioned tariffs, even when the pollster didn't bring it up. And I just mentioned this because it's always important to have our finger on the pulse of where our clients are at and where their concerns and where their worries are at, so we can counsel them and give them the proper information they need to make these decisions. So if you just had to bet, if you don't know how your clients are feeling, most of them are probably worried to some degree, even if they're not in the federal government, even if they're not worried about their job, maybe worried about their stock portfolio or worried about where employment is going in general or how the health of the economy is, because there are a lot of storm clouds on the horizon. Why do we look at economic data? And the reason is a flow chart. This is in the deck that I send out every month. I'm not going to go into a crazy amount of detail, but in short, all of these things we talk about with the economy, the segments of the economy, employment, inflation, retail sales, and manufacturing, industrial production, and then Fed policy, which is influenced by what's going on in the economy and administration policies. They affect the Fed funds rate. They can do quantitative tightening, quantitative easing, and then all of that taken with tariffs influence the bond market. Mortgage-backed securities are part of the bond market. Most mortgages are packaged into these securities that are sold, and it's a competitive environment. You're fighting for other investor dollars. How the bond market is doing affects the return you can get for mortgage-backed securities. If investors can sell mortgage-backed securities for a higher rate, then they can afford to offer mortgages at a lower rate. And so how the bond market is doing is the driver of where mortgage rates are at. Right now, the bond market hasn't been doing so great, and that is why mortgage rates have been a little bit volatile and increasing. Okay, now we're going to pop into these segments of the economy that all make up what I was talking about. And the reason, like I said, I talk about this is because this is what goes into mortgage rates. If you want to have an understanding of where mortgage rates are at and where they're headed, you either need to understand what's happening in the economy and what's going on with all of these different components, or just pop on here every month and have me explain it to you. Either one will suffice. So you can see here GDP for the most recent quarter was negative 0.3%. First time we have had a negative GDP quarter since Q2 2022. We had a lot of robust economic growth over the past few years, and that changed pretty rapidly. No shocker, we've been talking about this in the last couple of months, that these new administration policies have really had a depressive effect on the economy, and we can see that with the economic contraction here. So volatility, I said there's volatility in mortgage rates, and that's what we're expecting going forward. And if you were listening to what I was just saying about what's going on in the economy, influencing mortgage rates, it should come as no surprise that there's also a lot of volatility and a broad range of expectations when it comes to where exactly the economy is going to be. You can see that the Atlanta Fed, their GDP Now model, is projecting growth in Q2 of 2.4%. But if you look down here, this is the band, the blue chip consensus. These are respected economists who put a lot of time and effort into projecting where our economy is going. And you can see the projection right now for Q2 among respected economists is anywhere from -1% to 3%. I mean, that's crazy. I do not recall seeing a band this high of projection for GDP, anywhere from -1% to 3%. And that just tells you there is so much uncertainty that no one can say for sure what's happening, because there's so much left to play out, and how it plays out will impact what goes on with the economy. And thank you, Tam Tam. Appreciate the feedback and the comments. I said this last month, where it's still important to understand what's happening in the economy and run through these metrics, but the heavy hand of tariffs and some of these other policies are so powerful and so impactful that they can dwarf all of this. So we're going to run through it, but just take it all with a little bit more of a grain of salt than you would have previously. So the 1 month change in the consumer price index was 0.2% increase. The 12-month all items was 2.3%. And so this is something, it's like, normally this would be good news. These are pretty solid numbers. So even the 0.2% for the monthly increase, shelter accounted for more than half of that. And so the 2.3 for the 12 months, it was below expectations of 2.4, and that number by itself is a 4-year low. So this is the lowest annual inflation reported for a month that we've had in 4 years. But if you reached out to any economist, any expert, and asked them what this meant, they would say it basically means nothing. And this is what the Fed said as well, because none of this data is capturing yet the tariffs or the proposed tariffs. And like I said, that those policies, if fully implemented, and even what's been implemented already, are so impactful that they can overcome everything else. Talk about it coming up, but I heard an economist describe this as, if you look at, and we'll pop ahead, okay, getting ahead of myself here. So none of this really matters. It's so this inflation data is already dated because of the looming impact of tariffs. You're looking, this was data for last month. And so all of this stuff is just so much more powerful than what we're seeing. Jobs, you had 177,000 jobs added. That beat economists' expectation. The expectations were around 130,000. So 177,000 jobs, a little less than last month, but still a robust figure, a little bit either on track or a little bit higher than our monthly average over the past 12 months. If you look at the unemployment rate, what is the main driver? And so the part of the decline in CPI, you had gas prices drop a lot. And so like gas and energy makes up such a big component. Gas prices dropped, and that helped cover some of the increases in the other energy sectors. So that was one of the primary drivers in our more moderate CPI numbers. Thanks for the question, Taylor. So going back to unemployment rate, and as it connects to inflation. So unemployment 4.2. That's what it was last month. It's been 4.2 for quite a while. Taken independently, the CPI numbers, along with employment numbers, would tell you, oh, prices are stabilizing and employment is healthy. But as I started to say before, I heard a top economist mention that this is like looking out the window at a sunny day, but knowing a major storm is forecast and it's coming soon. And you don't know, say you're sitting in North Carolina, South Carolina, or Florida, and it's sunny and beautiful, and you're like, wow, this is kind of nice. But a hurricane is forecast to come through. The question is just, will it turn into a tropical storm, or will it fizzle out? Will it hit somewhere else, or will it hit us directly? And this is what's going on right now. These are all this is all sunny data. This is all positive, but the specter of what's coming is pretty dramatic and can still destroy all of this. So the deal that was reached with China recently, that was considered a win because it wasn't these 145% tariffs that were proposed, but it's still an increase on the existing tariffs. And as I talked about last month, it's 60 to 70% of the goods at Walmart, 60 to 70% of the goods at Amazon come from China. Target has reduced their reliance on goods from China, but they still receive 30% of their products from China, the largest single source country of their goods. A quarter of all furniture, a quarter of all clothing comes from China. And so if you think about it, any increase in that at all is going to put upward pricing pressure. And that's why expectations are that inflation is going to increase. So kind of giving all this away, where does the Fed think the economy is headed? Because there are a lot of smart people who study this all day long, and I already talked about what smart people are thinking. But anybody know what Chairman Powell said at the most recent meeting, which was earlier in May 6th and May 7th? He said they are in wait and see mode. So last meeting, as I mentioned, May 6th, May 7th, they held rates steady as was expected. The decision was unanimous. Nobody expected the Fed to do anything with rates given the level of uncertainty right now. And like I said, they're in wait and see mode because they, like everyone else, there's so much that could happen that hasn't happened yet that will have an outsized impact on the economy that they're not really sure where things are headed. Chairman Powell said that if the large increases in tariffs that have been announced are sustained, they're likely going to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment. And that's kind of a worst case scenario for the economy. It's stagflation, where you have the economy stagnate, but prices go up. And that's not really where you want to be. And the trouble with that is the Federal Reserve can only do one of two things. And I've said this before. They can either stimulate the economy or they can slow it down. And if they're worried about inflation, they can try to slow it down. And that's what they did with the record increases in the federal funds rate. And also, QE, QT, they can use that lever in either direction for that. If they're worried about the economic slowdown and they want to stimulate it, they can lower rates. They can start doing QE purchases. They can start buying up treasuries, buying up mortgage-backed securities, pumping money into the economy. And that can stimulate the economy, but it'll also stimulate inflation. So it's like, you can only do one of the two things, and they're in a very, very tough position. So it'll be interesting to watch what they focus on. But none of this bodes well for mortgage rates because it's just like all of this is not good for mortgage rates and goes back to the volatility and economic uncertainty. Yep. Yeah. Taylor commented, we're already seeing a drop in employment by many large companies due to slowdowns in the business. And that's also why, like, grain of salt, those employment numbers, yeah, robust, 177,000 jobs added, but those were jobs added in April based upon hiring decisions probably made in February and March before any of these tariffs were announced and before a lot of this stuff happened. And so we're going to see a lag in a lot of this data and also a lag in the impact. All right, 10-year Treasury, no shocker. It's up about 0.2%. I'm going to take a peek to see what it is this minute. This data was from yesterday or the day before. Right now, it is live market. It is 4.596, and it's just not good. It's not good. And this is, I'll go into more when I talk about administration policies, but generally, all things being equal, 10-year Treasury goes up, mortgage rates are going to go up, and that's happening now. Okay, retail sales. I'm going to speed through this. Retail sales were up 0.1% in April from March. That matched expectations. Industrial production. So industrial production overall was pretty stagnant from its April levels, but manufacturing output, the subset of industrial, like tangible goods, that fell by 0.4%. And I know there's been talk about the reason for these tariffs is to return manufacturing to the United States and build up the manufacturing process. And I'm not going to go into whether that will happen or whether that can happen. So table that for a moment. The short-term effect of tariffs is to put strain on all U.S. manufacturing because it is increasing the cost of everything. So if you increase the cost of everything, it just complicates the business model. And also it's like, how do you make decisions when you can't predict what's going on? So whether it's someday that could be successful or not, I'm not going to get into that political argument, but I can tell you that all of these policies are putting pressure on the manufacturing sector, and it shouldn't be a shock to anyone when they see that industrial production is steady or declining, because that's to be expected. Okay, now let's get to the focus, the reason why we are all here, and here meaning at least us real estate agents and industry professionals doing what we're doing. What are people seeing in the real estate market? What do people think is going on with days on market, inventory, prices, all of that stuff?
I'm seeing I had a conversation with a client yesterday who said, like, pretty much every single day she's hearing about the level of uncertainty, and she wanted to know how that's affecting the market. And I do agree. There's definitely certain levels of uncertainty that's affecting the market. And so I know for some of my listings, I've had to put out incentives to be able to help people like start moving on the listings. It's almost like if buyers are seeing it or buyers are seeing them and they're kind of taking their time and making decisions versus moving quickly. So that's something that I'm kind of seeing and experiencing.
Mm-hmm. Yeah, thanks, Demi.
Christina commented,
more inventory, more days on market, multiple offers and nice properties. Yeah. And all of that is true. And it really depends on where your business is right now, geographically and price point wise. So, yeah. And Tierney, that's true. There is more inventory, and in some markets that gives buyers the opportunity to negotiate credits and get a little more negotiating power, but not necessarily true everywhere. There are still a lot of really hot markets. Still, the majority of the DMV is in a seller's market, maybe not as extreme of a seller's market. And so it is, it's really interesting. So we'll take a closer look. First, just snapshot DMV to give an idea of where we're at, what kind of pace we are on. Right now, we are on pace to hit 50,044 transactions for 2025. Now, if that number doesn't mean anything to you, if you don't track annual transactions for the DMV, just know that's right about where we were last year. That's right about where we were the year before. And those totals, right around 50,000, those are the lowest numbers we had seen since 2008. And so just know that we are still in a very depressed market as far as transactions. My expectation, everyone's expectation, is that will continue so long as we have elevated mortgage rates. And it's because you have so many sellers who are just sitting there on 2.75%, 3% mortgages, who are really reluctant to make a purchase, because between the the appreciation, also obviously they'll capture that equity, but really it's like they could downsize and be paying significantly more for that next home, just with where interest rates are and property prices. Hmm. Yeah, Virginia mentions that suburbs is more, it because of inventory levels. There's everywhere outside of DC, and we'll focus on this in a minute, has more inventory than DC has more inventory than all of the surrounding areas. And DC condos do have like 6 months of inventory, but it depends on the segment. It's like the luxury kind of nicer condo segment in DC is a little bit hotter. So before we move on, just want to point out that we are basically, if you've been in real estate for a few years, this year should feel fairly similar to the last 2 years, except for all of the uncertainty. Kind of, we don't know what's going to happen, and that's the biggest change. But what has happened so far as pace we are on, very similar to where we were. And Taylor mentioned that he had 2 properties under contract relatively quickly, but not a ton of showings. And we've been seeing that for quite a bit. Showing levels are down, but new pendings don't track that. So there are fewer buyers out there, but the buyers that are out there are more serious. Median sales price. This goes back to if you have buyers who are thinking about waiting. And again, if you're looking at DC condos, things can be a little different. There are segments of the market where this isn't true or hasn't been true as consistently. But DMV wide, we are now looking at 23 straight months of year-over-year price appreciation. So if you had someone 2 years ago who was like, I'm just going to wait for mortgage rates to drop to buy a property, I mean, all of the properties they're now looking at are significantly more expensive than they would have been at that time, and mortgage rates haven't really dropped. I mean, they've come down from their peak of 8, but they've been in that 7-ish range for quite a bit, whereas prices have just steadily been creeping up. And then I also want to note, people are talking about days on market increasing. Excuse me, but median days on market for the region for April were still 7. I mean, 7 days. More than half of all properties are going under contract in less than a week. That is quick. That is relatively quick. And so I hear so much about it being a buyer's market, and it is in some segments, geographic segments, price segments, but overall it is not. Prices are going up, properties are going under contract relatively quickly. Yeah, wow is right, Taylor. I mean, it's just like, even with all this uncertainty, we're still seeing upward pricing pressure. So taking a quick peek at, yeah, that's an interesting point, Taryn, talking about being able to negotiate things even in a multiple offer situation. And I think it's important to note that even in these areas where it's still a seller's market, it's not necessarily as extreme as it once was. So sometimes it feels like just because it's like, instead of giving up everything as a buyer submitting an offer, instead of having a clean offer, cash, no contingencies, quick close, it's like you can have fewer contingencies and a credit. So sellers still have some leverage, but buyers have some too. And yes, Taylor, and that's median sales price there. So just taking a quick peek at closed sales and new pendings for April. And this is what I hinted at, saying April was giving us some information, but what we've seen from May so far is a little bit different. So closed sales pretty much on track with where we were last year. That's not a surprise. As I said, overall pace, we're right about the same pace as we were last year. New pendings dropped though. So we saw a slowdown of the market in April, and spoiler alert, we've seen that reverse course in May. And I like, it's hard to get concrete data on this stuff like consumer sentiment outside of the Michigan survey, but that's not tied to the DMV. It's not tied to people's intentions with their housing goals or housing actions. But my feeling, just based upon when things were announced, when things were implemented, when things were pulled back, related to tariffs, related to Doge, related to firings and then court stays for all of that. My feeling is that April, we saw a depressed level of demand in April because that's the tariffs liberation day was early April. So much uncertainty. People worried about what was happening, and buyers can change their course of action on the drop of a dime. And with all that uncertainty, I think some buyers were overwhelmed. Maybe they didn't know what was happening with their job and they just kind of paused. And that is what I believe reflects that drop of almost 7% in properties going under contract in April over the prior year. Now, in May so far, we saw that reverse. And I think that's just as things semi-stabilized, reached a deal with China, reached a deal with the UK on tariffs. And the expectations is like, okay, maybe things aren't going to be as bad, as dramatic, as expected. We feel more comfortable carrying forward. So that's my opinion. It'll be interesting to see how things continue going on. We had some intel. Susan joining us from Florida, wonderful Fulcrum colleague in Florida. She
Susan.
mentioned that they are seeing an increase in days on market there and seeing price drops. Different than the April data. And so that's something that I did a live Q&A instructional on Monday. And thank you for pointing that out, Susan. This is one of the things I said, like, if you're basing your counsel to your clients based upon national real estate data or national news article or what's happening in other markets, don't do that, because the DC market is very different. And Susan mentioned they're seeing more softening in the Florida market. And that's exactly what I would expect. Same thing happened during the global recession. We saw a lot of markets, just the bottom fall out, whereas most of DC was relatively stable. And that's what I expect going forward. We have very limited supply. We don't have, in core DMV, we don't have just large swaths of vacant land where someone can throw up hundreds of units of new construction. And so there's always going to be limited supply, and we have fairly stable demand. There are a lot of employers in this area, even beyond the federal government, and more than half of the jobs in this area are recession proof. So unlike a lot of other areas in the country, we have intrinsic, ingrained, systemic limits on supply and a variety, multiple natural factors increasing demand. So
Yeah. I think I think it's also important to kind of realize that it's still not it may be a seller's market, but it's still not the same level of a seller's
Mhm.
market. So still it's not the time to overprice listings and assume that you're going to get 15 offers. It's still like a 1 to 2 offer, multiple offers. So I
Mhm.
just got one that had 5 offers, but still that's not typical. And then
Mhm.
also not just condos in DC, but like if you're dealing with a luxury market, like those may have a little bit different numbers. So make sure you're knowing the stats for the price point that you are wherever you are.
Mhm. Yeah. And sorry, just dealing with some technical. Yeah, that is definitely true. And Susan also mentioned she's seen some days on market creep up in Virginia, and it is really is location specific and price specific. And there's still, we'll just carry on so we can start looking at this. I'm not going to cover anything. We covered most of this, just some more detail for March and April when you get it in the deck. But DMV wide months of supply 236, still a seller's market DMV wide. And so now popping into kind of county comparison. And it's just it's fascinating to note that sorry, getting some So this is one of the interesting things about live streaming across like 4 different platforms. And I have, if you would see my setup here, I've just got stuff everywhere and information coming from all areas. So I'm trying to make it as seamless as possible, but sometimes I get a little bit in overload. So excuse the hiccups there. Okay, so going into like the county comparison, so closed sales were a bit of a mixed bag. It was weird. Closed sales were down big, and this is for April. Just keep in mind this is for April, so a little bit dated. Down big in Northern Virginia. You saw a drop of about 13% in Alexandria, a drop of almost 10% in Arlington, down around 6% in Prince George's County and DC, but then up 6% in Loudoun, up 6% in Frederick. So prices though up everywhere. Even in DC, where we had been seeing some price softening, DC wide, we saw more than 6% appreciation in median sales price. And that reflects where they were at everywhere in the DMV for April. Prices were up 2.5 to about 6%. And so it's interesting that even with closed sales down in Alexandria and Arlington, there's still fairly upward pricing pressure. So just something to keep an eye on. The days on market, as usual, they were the highest in DC, but that was at 18. Days on market had been in, a lot of this is seasonal, but they had been up to about a month in DC. Right now, days on market for April were just 18 in DC, about 14 in Prince George's County. Everywhere else, and again, this is where like broken record here, but it can vary depending on like smaller area, smaller neighborhood, or price point. But county-wide, everywhere else, median days on market for April was 6 or 7 days. So homes are selling very, very quickly overall. And sometimes, like we've said, it doesn't feel like it because what used to be somebody trying to drop an offer in your lap if you went coming soon might take a little bit longer to get. But and across all property types. And there is some distinction when you get into fee simple, when you get into condos, depending on detached, attached, and price point. But still just kind of insightful, interesting to note. Moving on to new pendings, we have new pendings were basically up in Arlington, Loudoun, and Frederick. Frederick was almost even, but new pendings were down everywhere else. And again, this is for April, so a little bit dated. New listings were down in DC, interestingly enough, kind of down in Prince George's, but they were up everywhere else. And that's what we've been seeing more recently. We've been seeing increases in new listings, but something to keep an eye on because DC has had more inventory than everywhere else for quite a while. But with new listing levels dropping, that might be sellers reacting to the market and maybe postponing some decisions. Showings up in Alexandria and Arlington. Interesting if you've been listening to the other Alexandria and Arlington data, but showings up there down about 4 to 5% everywhere else. And that's what we've been seeing for quite a while. Showing levels have been down across the board for a bit. Going into active listings, we've seen, I think it's 14 straight months of increase in active listings, DMV wide, monthly, year over year, 14 straight months. And active listings are up by a pretty fair amount consistently through the DMV. But an increase, like I said this before, my joke is that a 50% increase of nothing is still nothing. And this is still the case. You see that DC is sitting there at 5.5 months of inventory. So you could say DC as a market is at equilibrium, not necessarily a buyer's market, not necessarily a seller's market. Now, as we've talked about, that it varies. It can vary a tremendous amount depending on exactly what your buyers are looking for or your sellers are selling. But just overall, you look at everywhere else. Arlington is at 2.5 months of inventory. Everywhere else is 2 months or below. 2 months of inventory is a seller's market. Excuse me. So it's still really, really low inventory throughout much of the DMV. Yeah, and Taylor mentioned active listings are up while new listings are down. And that's not a shocker because we saw that for the April data, we saw that new pendings were down and closed sales were down. And so we saw a decrease in buyer demand there which could increase depending on the numbers, the level of active inventory, even if new listings were down. Okay,
What's the difference between active listings and new listings, Paul?
active listings is all the inventory. Every property that is active on the market. New listings are listings that have come on the market within the time period. We're talking about April right now, so a new listing is any listing that hit the market in April, and then active listings are at the end of the month, everything that is on.
Okay.
And here, this section, I'm going to call it RIP Home Demand Index, because this is Bright has some kind of proprietary algorithm that I've never quite understood, and it just doesn't gel with a lot of the other data. So like all the data we just talked about, and with new pendings being down and active inventory being up, and this is reporting an increase in buyer demand. And there have been so many times where it just doesn't quite mesh with the data that I think it's more important. The home demand index is helpful if you're an agent who pays attention to nothing and just wants someone to tell you a number of where things are at. We go so much deeper than that here. So I would say, rather than looking at this little algorithmic defined where is home demand at, just listen to everything else we're talking about and see what's going on in your markets and talk to your fellow agents. And that will give you a much better idea of where buyer demand is than this number. So now this gets into the weekly data that I was talking about. And so this is reflective. Demand has been picking up in May. And I think it is due to that uncertainty that hit us in April. Things have stabilized just a little bit. People feeling a little bit more comfortable and continuing to move forward. New pendings, most recently reported month, were up 14% compared to a year ago. So that is a pretty sizable number. You can also see, though, the canceled listings are almost double of what they were a year ago. So we're having, and it's difficult to say exactly what's causing that, but it probably is some sellers moving forward with dated expectations. So even where it's still a seller's market, it's a little bit softer of a market, and there's no sure way to get a poorer result for your listing than to overprice it. And so I think you're seeing some properties get on that are a little overpriced, and those sellers are not having success. Now we're going to look at, yeah, Timmy?
No, I was going to say, yeah. I'm definitely seeing a few listings that have popped up. I'm always checking the property history on listings when they pop up.
Mm-hmm.
I just like doing that. And it's interesting how not a lot, but like several listings recently were previously listed maybe like a month or two ago, or a few months ago, or last year, and are just popping back up again with new agents at lower prices.
Mm-hmm. Mm-hmm. Absolutely. Going on to the county breakdown of the most recently reported week ending last Sunday. And so something I just want to mention here, if you're looking closely at this stuff, you'll see that the data down here for greater DC region does not match the DC metro snapshot. And that's not a mistake. I just want to point it out in case if anyone's paying close attention and saw that, actually be proud of you. You should get a shout out. So drop it in the comments if you noticed that already before I mentioned it. But the reason for that is this is core DMV metro core. And then this is greater DC region, which encompasses a lot of other counties. I don't include those counties here because they're not included in the DMV numbers that Bright releases and that we talk about. And so I just try to keep the area consistent. And most of us focus in kind of these core closer in counties. But obviously, if you're joining us from a county that is a little bit farther out, I would recommend you pop on to the MLS or Smart Charts if you have a subscription and just take a peek at your county specific data, because it could vary. But so just interesting to note, this is county breakdown most recently reported week. So new listings up everywhere, kind of consistent with what we've been seeing, except Frederick. If you're working a little farther out in Maryland, new listings were even in Frederick, and in Prince William, they were down by 10%. So there's a divergence there. They were up big in Loudoun, up big in Montgomery County and DC, all around 17%. And so you saw that, DC in April, new listings were down. that has reversed course, and we've seen a big jump in May so far. And we were up about 10.5% for the entire DC metro region. And this is something else when you're trying to glean what's going on here. And a lot of people are saying, oh, DC is so impacted by all of the stuff happening with the federal government. People are fleeing the area. And I've talked about this in prior months. And I'm not seeing that. I'm not seeing that personally. I'm seeing a lot of uncertainty. I'm seeing people talking about things, but I'm not seeing that happen both from a micro level or from the data. And you can see here that in the greater DC region, and this is even farther out than core DC metro, in areas that probably aren't as much affected by the federal government, you can see an increase 10.5% year over year in the new listings from last week. But the bright MLS footprint was 8%. So we're a little bit higher, but the whole region is seeing a similar level increase. So that's not to say that the federal government actions can't be having an impact. They definitely are, but it's not just, oh, all of these federal employees are being fired and people are going to flee the DC area. Inventory is going to shoot up and demand's going to decrease, because we're not seeing anything to reflect that. Median sale price, no shocker, has been happening for a while, up DMV wide, but it was down in Alexandria and Frederick, DC, basically even in Prince William, up everywhere else. So new pendings were down in Alexandria also. Interesting to keep a note on what's happening in Alexandria, how if these weeks are consistent, where the month ends up turning out. New pendings were basically even in Prince William, up a little in Prince George's, and then new pendings were up double digits everywhere. Going back to what I was saying, April seemed to be softening. Buyer demand seemed to be softening pretty consistently across the board in April. We're seeing a reversal of that in May. I think it's directly tied to a little more certainty than we were having before. And hit this in many different ways up to this point. So I've covered most of this, but it really is too soon to tell how these administration policies will be affecting the real estate market, because we still don't know exactly what is going to happen. I can tell you without a doubt, if the full panoply of tariffs, as discussed, are implemented, that will result in higher prices. That will result in a slowdown of the economy. And then related to that, so the budget that was just passed in the House, I believe, major expansion of the federal deficit. And overly simplified, but if you increase the federal deficit, mortgage rates are probably going to go up. So super overly simplified, but it's not helpful for the housing market. And so we expect to see, regardless of how these administration policies shake out, kind of expect to see it have a depressive or neutral effect on the housing market. But I don't expect things to kind of improve anytime soon. And by improve, I mean lower mortgage rates, more listings, kind of more equilibrium. Actually, I'm glad, Taylor, you mentioned that, because that's something I hit on so many times that I forgot to specifically mention this month. I want to go out. So new listings, and you can't see it here with active listings because of the way they have the chart, but you can kind of compare it roughly. And we are still not. So this is, you see this orange is 2025. So we're above last year's pace by a little bit. This band is the prior years. So even with increase we've seen in new listings, we are still at the low end of where we've been for the past few years. And where we've been for the past few years was lower than we had been previously. I always go back to 2019 for benchmark levels. And even with the increase in inventory, even with the increase in new listings, we're still below 2019 levels for the region. So like I said, an increase, like a big increase of nothing is still nothing. We still don't have inventory in a meaningful way. And the reason I keep hitting this is I get pushback from it all the time, with people saying, no, Paul, you don't understand. It's a buyer's market. It's a buyer's market. This is happening. That is happening. And it's like, no, it's just not as extreme of a seller's market as you are used to. But we are still classically defined by the data as a seller's market in most of these areas. 6 minutes left. My takeaways, I didn't change these from last month because everything's still pointing us in the same direction. The only thing you should be able to expect for certain going forward with the economy and this administration is volatility and unpredictability. So it makes it really difficult to determine what is going to happen. But expect volatility within a band, and that band is sustained higher mortgage rates and increasing inventory, not expecting anything crazy, but just kind of continuing on our current trajectory, but things can be changing. And so that's why if we have any consumers on here, it's important to get great counsel from expert agents. And for the wonderful agents on here, it's just important to stay up to speed on all of this stuff and what's going on. Still a good time to buy. Like I mentioned, prices have increased for 23 straight months. If you're a buyer, or if you have buyers who have been waiting to buy, all that has happened is all the homes they would like to buy have become more expensive, and it's cost them money. You can always refinance later. And get out of that lower rate, but you can't pay a lower amount for a higher price house. And sellers still have the advantage. As we've heard in a lot of the comments, and thank you for everyone for your contributions, sellers don't have as much of an advantage in some markets. And if you're selling a non-luxury DC condo, you don't have an advantage at all. And it is a buyer's market. But overall, sellers still have the advantage. So if you have any questions or comments, feel free to reach out. You can drop it in the comments here. You can also email me or shoot me a direct message. You can also, if you'd like to get on the distribution list for my deck for these sessions, just send me an email and request that. Any closing thoughts? We've got 4 minutes left. Temi, thoughts on what's going on? More questions or comments from those of you joining us?
Every time I'm on this, like I always get some really good insights. I can see because I have listings that are flying off the market. My focus this year is, is my seller is getting more listings, and I have listings that are flying off the market, and then I have listings that some are just sitting, and so it's always good to kind of revisit the market and just kind of see, okay, where are things? What should I be telling my clients? How should I be pivoting? And so because I will say this is the first year I've gotten a lot of um, articles from my clients because I'll tell them what I'm seeing in the DMV, and then they will send me like several different articles from several different news resources, and I usually will open it and read it, and it's always national, and it's always, for the most part, it's typically national. It's not always national, and it's saying something negative about the real estate market. And I'm just like, thank you, thank you for this article. But it's not based in the DMV, so this is helpful to be able to be on these calls and get a fresh take.
Mm-hmm. Absolutely. Absolutely. I get that all the time. All the time. And it's like I said before, it's usually what's going on nationally. I mean, trends might overlap, but we are in a unique market. There are only a few places I would practice real estate in all of the country. And like here, I mean, I've lived here for a while. I love this area, but it's also, there's stabilizing factors that don't give us as much, even in volatile times, they don't give us as much volatility. So yeah, anytime, it's like, if you have clients reaching out to you with national articles or you're reading them, make sure you understand whether that differs from what's going on here before repeating and regurgitating that. Thank you all for joining us. And if anybody missed some sections of this or knows somebody who might find this useful, momentarily after this is over, it will go up on the YouTube channel and be there in perpetuity if you want to take a closer look. But thanks again, Temi, for all of your wonderful contributions and moderating. Thank you, everyone, for joining us, and we will see you next month.
Did you guys like the comment section being on the screen? That's something
Yeah,
new. It's a beta. Like, I'm not sure if you guys like to kind of see it on the screen. I don't know. I guess you're on YouTube, so you can already see the comments. But yeah,
yeah,
let us know. Sorry, let us know.
yeah. I found for me it was obstructing some of the data. It's like because
Yeah,
of how it was set up. But
yeah.
all right. Well, I hope everybody has exciting or relaxing Memorial Day weekend plans and get out and enjoy not so beautiful weather here, but looks like it's going to warm up later. Love it, except when it's distracting. Yeah. we hear you, Christopher. We hear you.
All right.
All right.
Thank you
Thanks
guys.
all. Take care.